Hi, folks, and welcome to Money Ed Financial Academy. I'm your instructor for today, Jerry Penner. Today, we're going to talk about stock analysis for creating a retirement portfolio. If you've created a financial statement, use that statement to build a budget, and have paid down your debts, you're probably wondering what to do with all that money you have available now. It's time to start thinking about creating a retirement fund. If you remember the Thinking Rich questions in Lesson 3, you'll remember that poor people think in terms of capital gains, while rich people think in terms of dividends. With capital gains, you perform a stock analysis, buy one that you think is undervalued, wait for the price to go up, then sell it for a profit. If the price goes down, you lose. If the price stays where it is, you lose the time value of money. If the stock goes up, you sell and realize capital gain, then perform another analysis to buy the next undervalued stock. With dividends, you perform the analysis once. When a good dividend-paying stock is found, all the analysis work is done. All you have to do is keep buying that stock and reinvesting the dividends. It's like buying a rental property where the tenant pays on time and in full every month. So what are the criteria for a good dividend-paying stock? Here they are. Let's discuss these in order. By choosing domestic stocks over foreign stocks, I avoid complications like foreign exchange rates during the buy, sell, and dividend distribution, as well as any CRA rules regarding foreign investments. I like keeping things simple. If you want to trade with the extra complications of foreign currency exchange for higher returns, be my guest. There are other markets that can perform better than the Canadian market, but I like to keep things simple and boring. A 4% minimum annual dividend means that when I amass 25 times my annual income, I can stop investing and live off the dividends. A lower dividend percentage means I have to invest more to get the same annual dollar output. A high dividend paying stock is of no use in a retirement fund if it doesn't pay out regularly. What happens if a stock either cuts its dividend or stops paying altogether? The stock price drops. Now you have your money invested in something that is not working for you. And the lower stock price means you actually lose money if you sell to get out and buy something else that performs better. If the stock price isn't rising over the course of the past 5 years, something is wrong. It doesn't matter what. It could be mismanagement, shifting consumer demand, scandal, competition. It doesn't matter. What matters is that if a stock is consistently dropping when the rest of the market is rising, the stock is toxic and needs to be avoided. The payout ratio is the annual dividend payout amount per share divided by the annual net revenue per share multiplied by 100. If the payout ratio is over 100%, where's the money coming from? They might be borrowing it, hoping for future revenue gains to repay the loan and keep going, or selling assets to maintain the payout. In any case, this is unsustainable and usually precedes a dividend cut. An 80% dividend payout is a good, safe maximum number. Lower is better. As the ratio goes lower over time, this indicates the company may raise the dividend. Dividend increases are important. If a stock has a high-paying dividend but no annual increases, inflation will erode the value of the dividend. The Bank of Canada strives to keep the rate of inflation between 2% and 3%. If you can find a dividend-paying stock that increases its dividend annually above the rate of inflation, it's like getting an automatic pay raise. So we need to contact a financial advisor to provide us with the list of stocks that match these criteria, right? No! All the data is available online for free and can be harvested with an internet browser and a dollar store calculator. First, we go to ca.finance.yahoo.com. Under the search box, click the My Screeners link. In the My Saved Screeners section, click the Create a New Screener button. In the All Screeners section, change Region Is to Canada. Delete the other 3 filters by clicking the X button beside each filter. Click the Add Another Filter link. In the pop-up box, scroll down until you come to the Dividends and Splits section. Check the checkboxes for consecutive years of growth and forward dividend yield percent. Click the Close button. In the consecutive years of dividend growth greater than filter, enter 4 in the text box. In the forward dividend percent greater than text box, enter 4. Click the Find Stocks button. If you were watching the estimated results number, you would have seen it drop from nearly 3,400 to 21. With these 3 filters, we have eliminated over 99% of stocks in the TSX universe. The results list has 21 candidates. Let's go to the top and start the analysis. In the results list, right-click the top symbol, ry.to, and select Open Link in New Tab. Click the New tab and observe the summary. Click the 5-year link under Summary to expand the chart to show the stock price for the past 5 years. We can see that the price has increased from 5 years ago with a dip at March 16, 2020. That was the week the market reacted to the pandemic shutdown. Under the chart in the right column, we can see forward dividend and yield. The number is the annual dividend in dollars. The percentage is the dividend dollar amount divided by the stock price multiplied by 100. Both of these checks pass. For the payout ratio, click the Statistics link. Scroll down to the Dividends and Splits section and look at the payout ratio. In this case, the ratio is under 51%, well under the 80% limit. This check passes. Now let's scroll back up and click the Historical Data link. Set the time period to 5 years. Click the Historical Prices drop-down and select Dividends Only. Click the Apply button. Royal Bank pays out quarterly, so we should expect to see 20 entries. When we count them, we see there are 20 entries indicating no missed payments in the past 5 years. Looking at the list, we see that the payments have been going up over the past 5 years. There are no cuts. This check passes. The dividend increase check is going to require your dollar store calculator. Note the oldest dividend payment and the newest dividend payment. The oldest one in this case is $1.02. The newest is $1.38. Now perform this calculation. We see that Royal Bank has increased its dividend by over 7% each year in the past 5 years. This check passes. When was the last time you got a 7% raise for doing nothing? Hooray! The stock passes all 6 checks. It's a good one. But how does it compare to the others that we haven't analyzed yet? This calculation shows how much the percentage dividend will be in 5 years compared to today's stock price. This number is important because it allows us to compare future dividend growth against other stocks to see which one will provide us with the most dividends in 5 years. This number can be used to rank order the stocks that pass our 5 checks so we know which ones to buy for the greatest future gains. For today's homework, perform the analysis I just showed you on the rest of the stocks in the list. Throw out any that don't pass all 6 checks. Rank order the remaining stocks based on their future earning potential. You now have a list of stocks to buy for your retirement. There is nothing left for you to analyze, ever. Just buy from the list whenever you have enough money to pick up 100 stocks at a time. Reinvesting the dividends will get you there faster. If you want to make more work for yourself, you can perform this analysis annually. The order may change slightly, but it's unlikely that any stocks will be added or removed from the list.